Welcome back to the Deep Dive, where we cut straight through the noise of market commentary.
Hey there.
Today, we are wrestling with a situation that really seems to defy market logic. We've got a holding company that just dropped Q3 2025 earnings, which were, by all measures, just an unmitigated disaster on paper.
Total disaster.
Yet the stock barely moved.
Right. And that's the puzzle we're dissecting today. We're looking at Compass Diversified, ticker CODI, and their fiscal Q3 call from January 14th. And the mission for us, and clearly for the market, is all about reconciliation.
How do you square those two things?
Exactly. How do you square abysmal headline numbers with a, surprisingly muted reaction? It tells you that investors are looking past the wreckage. They're focused entirely on management's roadmap to stabilize things after a massive internal shock.
And that shock, of course, is the Lugano crisis. For anyone not following this saga, Lugano was a luxury retail subsidiary, and its collapse was, it was a body blow for the company.
Mm-hmm. Severe inventory issues, massive write-downs, and ultimately a Chapter 11 filing. It forced management into triage mode for the entire last quarter.
That context is everything.
It's vital. And it's why, before we even get to the numbers, we have to mention the personnel changes. It really signals a new phase.
Right.
You had the retirement of Pat Mazzarello and Jim McGlory, both after 2 decades of service. But the really telling move, I think, was promoting Zach Sautel to COO of the management company.
That signals a shift to internal operations, to stabilization.
Exactly. It's management saying, we dealt with the past, now look at the future.
Okay, but to get to that future, we first have to confront the numbers, because the Q3 figures were, frankly, brutal.
Oh yeah, prepare yourself. These figures missed across the board. GAAP EPS came in at a staggering loss of negative $1.21.
A loss of $1.21, the consensus was for a profit of 61 cents.
It's not a minor miss, it's a negative delta of $1.82 per share, a complete blowout.
A miss of that magnitude usually sends the stock plummeting, 10, 20%.
It should. And it wasn't just EPS, the revenue picture was just as bleak. Net revenue was $472 million.
Missing by almost $100 million.
$100 million. And year-over-year sales growth, just 3.5%. GAAP net loss from continuing operations was almost $87 million. All signs pointed to a quarterly failure of epic proportions.
And yet, and this is where it gets really interesting, the stock closed the next day, essentially flat. It was up, 0.19%?
Barely moved, but the volume spiked. 3.3 times the daily average.
So that tells you everyone was watching.
Everyone was watching and digging into the commentary. This is the definition of a market that had already priced in the worst-case scenario. The focus was 100% on the cleanup and the path forward.
The bad news was baked in.
Completely. The market believes the core problem is isolated and, more importantly, contained.
So if the financials were garbage, the first piece of good news has to be the cleanup. Management's #1 priority was getting back into compliance.
That was the biggest victory they declared on the call, and it's essential for regaining trust. Management stressed they are now fully current on all their SEC filings.
And their credit facilities.
Yep. Restored compliance there and with their bond indentures. For a company under this much stress, getting back to a normal operating cadence is step 1, and they hit their deadline.
But can you really quarantine a disaster like Lugano when the results still include that financial drag? Isn't that just management spin?
It is strategic spin, but it's based on a real separation. They emphasize that these ugly results still include the drag from Lugano right up until its Chapter 11 filing date on November 16th. So that subsidiary was absolutely masking the health of the rest of the portfolio.
And do we know the quantifiable drag? How much noise are we filtering out here?
We do. And it was substantial. Lugano alone posted a negative $9.9 million drag on subsidiary adjusted EBITDA for the quarter. So once you strip that out, the focus shifts entirely to the 8 remaining subsidiaries. The healthy core.
So what did that healthy core actually deliver in Q3?
Okay, so subsidiary adjusted EBITDA, ex-Lugano, was $30.3 million for the quarter. Now, we have to be clear, that's still down from $48.6 million the prior year.
Okay, so still down.
Still down for the quarter. But, and this is what analysts were really looking at, the year-to-date performance tells a much healthier story.
Right.
Year-to-date, again ex-Lugano, subsidiary adjusted EBITDA showed a 5.8% increase. It's up to $257 million. That's the disciplined execution they kept talking about.
And that year-to-date growth, that's the proof point the market was clinging to.
That's it. Which leads us to the guidance, because despite all this Q3 turbulence, they reaffirmed their outlook, right?
It did. They're sticking to their full year 2025 subsidiary adjusted EBITDA guidance, ex-Lugano, of $335 to $355 million.
Which is a huge vote of confidence. It suggests that they believe the current portfolio is stable and on track.
Okay, so let's drill down into that portfolio. On the consumer side, low single-digit growth. But the clear star of the show was the honeypot.
Oh, yeah. Significantly outperforming expectations was the quote. And what's really driving it is strategy. They successfully extended the brand beyond its original niche of washes and wipes.
And they moved right into the massive menstrual care category.
A genius move. They're not just growing a niche anymore. They're actively taking market share from huge legacy players in a multi-billion-dollar category. It's driving strong double-digit EBIT growth.
And you have BOA, which looked like it declined slightly.
It did, but again, you have to look under the hood. That decline was planned. They intentionally exited a lower value, less performance-oriented children's business in China. They cut that revenue on purpose.
So it was a strategic choice, not a demand issue.
Exactly. And the payoff is clear. The core BOA business, the high-performance fit systems, that business actually grew double digits. They traded low-margin sales for strategic focus.
On the flip side, 5.11 Tactical seems to be struggling a bit.
That's where you see the macro headwinds hitting. Their customers are price sensitive, and they're really hesitant to accept price increases, especially with that ongoing 20% tariff burden from their sourcing in Southeast Asia.
So they're just trying to protect margins there.
Pretty much. Now, on the industrial side, mid-single-digit sales growth. And the story here is all about Arnold. This is a classic case of short-term pain opening up a huge long-term opportunity.
Okay.
What's fascinating is the immediate hit they took. Millions of dollars of EBITDA disruption because of China's export restrictions on rare earth minerals. That hurt the quarter, no question. But that exact disruption has fundamentally changed customer behavior, especially in aerospace and defense.
Where supply chain stability is everything. It trumps price.
Absolutely. Arnold is one of the very few companies that can produce high-performance samarium cobalt magnets here in the U.S., so customers are now demanding a stable, non-Chinese supply chain.
It's become a national security issue for their clients.
It has. And as a result, their backlog is growing, and management now expects a materially higher growth rate over the next 3 to 5 years. It's a fantastic long-term story born from short-term pain.
Okay, so the portfolio seems generally healthy. But the elephant in the room is the balance sheet. That debt load is it's huge.
It's overshadowing everything. You saw $66.7 million in net interest expense for the quarter. That tells you deleveraging isn't a choice, it's an existential need.
Which is why that December credit facility amendment was so important.
Crucial. It restored full access to their $100 million revolver, and more importantly, it relaxed their covenants through 2027. But this flexibility comes with a very big catch.
A ticking clock.
Exactly. A ticking clock aimed right at management. There's a clear incentive structure here. A hefty milestone fee kicks in on June 30th, 2026, if their leverage ratio isn't below 4.5 times.
And where are they now?
They expect to be around 5.3 times, ex-Lugano. So they have a significant gap to close, and they have less than 6 months to show major progress, or they pay a penalty.
So how do they close that gap? This is where their free cash flow forecast becomes the real game changer.
This is the linchpin. This is why the market was forgiving. Management is forecasting that the business will generate between $50 and $100 million of free cash flow in 2026.
50 to 100 million, that's a huge step up from what they've done historically.
It is. And critically, this is FCF after interest, preferred dividends, and CapEx. The big change is they eliminated the common dividend, and they're laser focused on working capital. Every single dollar is going to debt pay down.
So that gives them an organic path to deleverage, even without selling anything.
It gives them breathing room, but they're not just relying on that. They confirm they are aggressively pursuing strategic asset sales.
Right, the old everything's for sale at all times line.
That's the one. But they were quick to add they will not take a big discount on a premium asset. They're apparently looking at multiple assets to maintain leverage, with reports pointing toward the honeypot, given its incredible performance.
Okay, so that brings us to our next segment. This is the part we call not financial advice. where we lay out an outrageous but plausible trade idea based on all these catalysts.
And this setup is uniquely binary. The stock is flat, the bad news is out, but management has laid out a clear roadmap with a massive incentive deadline. That clock is ticking to June 30th.
So our pitch centers entirely on management's self-interest in hitting that 4.5x leverage target.
They are heavily incentivized to get a deal done quickly to avoid that milestone fee. The organic FCF path is good, it's solid, but it's slow.
Too slow to beat the clock.
Well, probably. So they need a quick liquidity event. And an asset like the honeypot is performing strongly enough that they could demand a premium valuation even in a tough market.
So the trade idea is what? A near-term bullish options play?
That's the idea. Something like buying out-of-the-money call options that expire in mid-2026. This is a pure bet that a high-value divestiture gets announced. Let's say they sell the honeypot for a big multiple.
That sale would serve as the quick liquidity they need.
Exactly. It would accelerate their deleveraging far beyond what organic cash flow could do by mid-year. If they hit that 4.5x target early, or even just announce a sale at a great price, you could see a massive, immediate re-rating of the stock. It's pure catalyst hunting.
And the risk, obviously, is that it's all timing. What if the M&A market is terrible and they can't get their price?
That's the whole risk. If they stick to their no big discount principle and a good offer doesn't materialize, they might just wait it out past the deadline. They'll rely on FCF, they'll miss the target, pay the fee, and the stock probably goes nowhere.
So it's a bet on M&A execution, not on the underlying business performance.
Precisely.
And that wraps up our deep dive into Compass Diversified's Q3 2025 call.
So to recap, the quarter was a numerical disaster because of the Lugano cleanup. But operationally, the core business is stable, even outperforming in spots like the honeypot. The company has stabilized compliance, they've confirmed strong FCF for 2026, and they're actively looking to sell an asset to fix the balance sheet.
The market has given them a lifeline. It shrugged off a massive miss because the focus is now entirely on the future. And that immediate pressure point is the 4.5x leverage target.
But I think the deeper question, the final provocative thought here for CODI and their whole model, is whether a catastrophic failure like Lugano just fundamentally damages the market's trust in their due diligence process long term.
Even if they sell the honeypot for a great price.
Even then, can they really rebuild investor confidence in their ability to buy companies after such a spectacular internal breakdown? That's the real execution question for 2026 and beyond.
A very good question. Thank you for joining us for this deep dive. We'll see you next time.